Adobe and Shopify are two interesting growth stocks that investors are considering adding to their portfolios. But which one is the better stock to buy at current prices? That's the question I'm going to answer in this video by comparing these two stocks on revenue growth, on profitability, on cash flow, on the returns on invested capital. Finally, I'll look at their valuations using two different methods, the forward price to earnings ratio and my discounted cash flow valuation models for Adobe and Shopify. So let's get into this. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So looking over the last decade at revenue growth, each of these two companies has demonstrated solid expansion. Shopify better than Adobe at 8.2 billion compared to a little over a few hundred million in 2015. Adobe, meanwhile, has increased its revenue by over 4x from around 5 billion to over 21.5 billion. Now, looking at growth trends, secular growth trends, Shopify has the advantage here as people continue to spend more money online because of the incredible convenience advantage it offers. There is no way, well, I shouldn't say there's no way, but there's little chance that a brick and mortar business can offer a better shopping experience than an online business, at least not with the technology available today and not with the macroeconomic factors that are in present conditions. People can sit at home, order what they want, have it delivered to their doors. They can shop at 10, 12, 20 different stores within an hour, where if you were doing that in person, that would be impossible. That favors Shopify significantly. Adobe, meanwhile, faces secular headwinds because of the rise of competition, easier services to use, and the newer AI-based services that could facilitate more consumers switching and choosing those free or lower-priced AI-based services. So Adobe not facing those similar tailwinds like Shopify has. So the next thing I wanted to compare these two on is their operating profitability. You can see extreme volatility here for Shopify. I will talk a little bit more detail about that. But Adobe has demonstrated excellent expansion in their operating margin to 36%, almost double where it was in 2015. Shopify has demonstrated improvement as well, going from around negative 20% up to 11%, but with significant volatility here following the pandemic. Now, there were several factors that led to that. Of course, most notably, the pandemic helped Shopify's business because more people were shopping online instead of in person. That created a surge, not only in consumers spending money online, but also businesses moving their services online or expanding their offerings online, going to Shopify's services offerings and seeing where they can expand, where they can add new things to their capabilities. And so that led to a surge. And then, of course, the economic reopening reversed that trend. But not only that, Shopify, in my opinion, made a decision that's questionable. I certainly didn't like it, and the market didn't like it either, when they decided to spend billions of dollars to add fulfillment and logistics to their offerings. They used to have, prior to that, an asset-light business model. After that, they went into that capital intensive, similar to what Amazon tries to do for their sellers. And that's an incredibly difficult thing to accomplish and very expensive at the same time. So a high degree of difficulty and very difficult on execution. Amazon has done that phenomenally well. Amazon is the rare exception to those businesses that have been able to do the whole fulfillment and logistics thing effectively, efficiently, and at low cost. Shopify wasn't able to do that, and the initial results they were seeing was so bad that they reversed that decision. They sold off their investments, their logistics business, and they backed away from that. And that's why you see this increase in margin following that sale of the logistics business. Looking at cash flow from operations to sales, Adobe at 37 is more than double that of Shopify at 17. They've both been improving this metric over the last decade. Again, you see the same volatility with Shopify because of those factors I highlighted earlier. But Shopify has demonstrated better improvement over the previous decade. And I suspect that over the next decade, Shopify will close this gap or narrow that gap between itself and Adobe in the cash flow from operations to sales because of that stronger tailwind. I suspect more revenue growth for Shopify. And given that they chose not to employ that capital intensive business model, they'll be able to improve cash flow as revenue increases. The last metric I'll look at before we go into valuation is the return on invested capital. You can see Shopify demonstrating excellent growth in this metric. That is until they made that blunder with the logistics business, and that investment did not deliver good returns on invested capital. The company had to sell that business at a loss, and so that led to a big decrease in this metric, and it ruined this pristine reputation that Shopify's management had up until that point. Up until that point, Shopify's management team had been operating the business almost flawlessly. They had been getting credit from all sorts of investors for being an excellent management team. And then that multi-billion-dollar blunder in the logistics business really hurt that reputation. They still have a great reputation because it's only one mistake over uh, over all those years, but it's a very costly mistake as the company spent multiple billions of dollars. They made an acquisition, a $2 billion acquisition of Deliverer, and then they also spent a couple of $1 billion expanding their own logistics part of the business. And so all combined, that was a multi-billion-dollar decision that turned out to be a very poor decision from results that came back very negative. So now they're recovering from that, and I don't have very much doubt that they can return to those improvements they were demonstrating before that decision. Hopefully, they don't fall into that same trap again in the future and say, well, now that we're in a better position, we can try this again and try to do that same thing again. I hope they don't try and incorporate that strategy in the future. All right, so now let's get into valuation. Shopify is trading at a forward price to earnings of 54 compared to 17.6 for Adobe. So Shopify is roughly 3 times as expensive as Adobe on a forward price to earnings basis. And then when we look at the discounted cash flow model, I have Adobe at $397 versus the current market price of $406. So I have Adobe stock fairly valued on its DCF. Shopify, my intrinsic value is $53 and the current market price is $104. So I have Shopify stock overvalued compared to its DCF. So all things considered, if I had to pick between these two growth stocks, I would pick Adobe over Shopify. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.